Hey, what's going on, guys? This is TerrenceRe back at you with another stock market update. In this update, we're going to talk about the week ahead. Today is Sunday. This Super Bowl Sunday. Let you guys know right now who I'm rocking with. Rocking with the Eagles. Uh, Jalen Hurts going to do his thing. I think he's going to have to. I think the Chiefs going to sit back. They'll probably have their safeties back. They won't let A.J. Brown beat him over the top. So Hurts gonna have to run a little bit today, which would be cool. You're gonna have to break them down and run a little bit because they're gonna keep the safeties back to keep from getting thrown over the top. At least that's how they played the Bengals anyway. So he gonna have to make some moves, with his feet. Score prediction, yeah, I think it'll be a close game. Patrick Holmes is phenomenal. Um, Andy Reid calling plays. Probably come down to the fourth quarter. I'm gonna roll with the Eagles, 30-24. 30-24. You got my pick. All right. Now let's go ahead and get to this to the market. So we're gonna talk about the week ahead. Right now, I got up on the SPX. I already used to the channel. You see that I have my expected moves set up right here for the week. And on the SPX, we come to the options tab. We're going to look at this one. Now, you may say both of these say February 17th, right? But this one says AM. That's because this monthly expiration right here, this AM expiration, it doesn't expire on Friday. Well, this one expires Friday afternoon. This one will expire on Friday, but it's basically going to use Thursday's price. So you wouldn't be able to get out of this trade. I never trade these. I never trade AM settlements. That's just me. I always use because it's a different type of option and it has a different type of settlement. Instead of this one right here, you will have to Friday afternoon, and it will at the end of you'll get the price at the end of Friday. This one right here does not work that way. You're gonna get the price Thursday, whatever it closes on Thursday, um, after the bell. And I believe they call that the set price or something like that. But as I was taught, I just don't trade them. Or if I do trade them, I'm out of them. I do not hold these trades until try to hold them until that day, right? So just remember, this is a different type of settlement. Now you can go to the CME or you can Google AM settlements and then read up on that, right? So when I use my weekly prediction, that's why you see the expected move is a little different. They have the same date, February 17th, but you have a different expected move. This one has 99, almost $100. Now last week's expected move was about, I think if my mind serves me well, it was like 73. May have been 72.99 or something like that, but 73. And you see today we got a larger expected move for the week of 99, right? So we're gonna get a little bit more volatility is being priced in the market right now. And with that being said, we can expect a larger move. So you may ask, why do I look at the expected move? Basically, what that's telling you is if we were to get 100 size move, let's say when the market opens up Monday morning and we get a gap up and we're up here at 4,200, that lets you know that we're already outside the expected move for the week on the first day. So we could really get a big move, or what I would tend to bet at that point is at some point later on in the week we're gonna pull back in to that range. So it kind of gives me price targets for any intraday trading that I may or may not do, and it gives me targets for any type of swing trading, right? And it lets me know what size move I may get for the week, so what to expect. Uh, one other thing that I wanted to look at now that we know that we're expecting more of a move this week, let's look at volatility. Because I also want to talk about in this video, like what to watch, right? Things that I look at on a regular basis. I always want to look at what vol is doing. And do that with the VIX, and the VVIX, right? The VVIX, which is the volatility of the volatility. And if we look down here at the VVIX, we can see that last week we got a gap up and we got some movement. MACD crossing over the whole nine. So that's letting you know that volatility of the volatility is spiking up. And we're going to start getting, if that's happening, then you got to expect the market to have larger sized moves. Now, we don't know which way the market's going to go, but we do know that with volatility of the vol being up, that we're going to get some erratic movement. Now, that helps you in a lot of ways, because generally when I see something like this, I'm going to more than likely bet that the market's going to be short. For vol to be increasing and the market to be going up, that is really I'm not going to say it never happens, but I wouldn't bet on that happening, right? So we got this gap up. So the VVIX is up. So vol is going to be moving next week. We couple that with taking a look at the bonds. Let's look at the bonds. We're going to go to the 2-year. I'll look at all of them, but let's start with the 2-year. The 2-year is the one that's going to move, or in this environment, a little bit more erratically, especially with us, not us, because I ain't doing it, but with the Fed raising interest rates. You got the 2-year bond. Look at it on this downward path. You see I got Fibonacci levels. We've already passed 1 level, 2 level, 3 levels. And the MACD is to the bear side. So we have both moving averages on the MACD below the 0 line. The histogram is steadily making lower lows. Also, with that being said, and we're not quite oversold yet at 34.3. Now, let's go to the 10-year. Now the 10-year has a level to hit. So I suspect that the 10-year, once it hits right around in here, that we may get a little bit of a bounce. But with these moving averages crossing over right here, I don't expect us to get much of a bounce. It could just flush straight down. So I am short bonds. And I have, if you're looking at the video, you should see, if not at this time, probably in a few hours, there will be a join button to join and become what I call an active trader, and support the channel. And one of the perks of that is I'll show at least 1 trade per month, like when I do, not like after the fact, but when I do it. So at least 1 trade per month. If you follow me in that trade, be careful. Use small size and things of that nature. Do not and be comfortable with the risk. But it's just basically just as a perk for people who just decide to support the channel. I'll post at least 1 trade a month from my YouTube account, which is what this is. And then you guys will be able to see, like, when I got in. And I'll also post when I'm taking it off. So that's something that's new, going to be coming to the channel. Now let's get back to this. The 30-year, same thing. See, I just don't have the Fibonacci levels on here, but they're all going down. I've been talking about the bond yield relationship in my past few videos, because this is what we're watching right now. If you watch the bonds and you watch the yields, the treasury yields, If we are paying attention to these chart patterns, this is going to help us get a gauge on where the market is going. As the bonds go lower, yields go higher, we still should see the tech going down. That's why you see right here on Friday, Amazon closing down. That's tech. Google closing down, tech. Microsoft closing down, tech. Some may not I call Tesla a tech company, right? But some may not. Either way, whatever you want to call it, down. Netflix, whether you want to call it tech or not, down. Boeing obviously isn't a tech company, a Caterpillar, but they were up. So, well, that's the relationship we're going to keep an eye on this week. We're going to watch the yields, we're going to watch the bonds, and then we're going to watch tech. Also, I am bullish on the financials. I did go to cash. I talked about it on the last video. In my 401k, I am in cash. I closed out positions that I had in the XLF and the XLE because, and I talked about it. Go check out the last couple videos where I talked about why. I'm gonna sit it out for a while. I can always get back in and just keep putting, my money in and keep getting the match from my employer, and I'll sit. I don't have FOMO. I don't worry about FOMO. People talking about fear of missing out. Nah, fear of losing, which is not a good fear to have, to be honest with you. But it's not necessarily losing. I would put it like this, because I don't mind. Actually, I trade pretty frequently, and it doesn't bother me when I lose because I don't make too large of a trade. But what I will say is this: if all the signs are pointing like they pointing now, I'll sit it out and wait, and then I'll pick a good place to get in. And right now, if you have access to the treasury yields, I like treasury yields, right? So with that, guys, with that being said, enjoy the game today, and then let's get ready for the market when it opens up Monday morning. With that, I'm gonna be out. Peace.